You guys ready? Yeah. Okay, good morning, everyone, and welcome to the investment meeting for November 2011. We are now in the public session, and with that, let me turn it over to the chair. Commissioner?
Good morning, everybody. Let's go around the room. I'm Andy Schaefer, representing Commissioner Kelly.
Barry Dennis, SAS.
Dan Torelli, PBA.
Joe Alejandro, PBA.
Joe Strong, PBA.
Chris McGrath, PBA.
Bob Ganley, SBA.
Steve Rebellia, LBA.
Roy Richter, CPA.
Michael Palladino, DEA.
Bob North, Actuary.
Barry Miller, Controller's Office.
Martin Gans, Controller's Office.
Seema Indrani, Controller's Office.
Davin T, Controller's Office.
Larry Schloss, Controller's Office.
Ranju Nagaswamy, Mayor's Trustee.
Janice Emery, Office of Finance.
Inga Van Eysden, Law Department.
Kevin Holleran, Police Pension Fund.
Bob Sanchez, Fed Pension Fund.
Anybody else?
Vermont Controller's Office.
Yvonne Nelson, Controller's Office.
I'm Kevin Arrow, Pension Fund.
Okay, with that, we'll turn it over to Larry.
Okay. There's a public agenda today. We're going to start with a couple of representatives from Barclays who are going to talk to us on a quarterly basis about the economy and what's going on. And then we'll get into the monthly performance and some asset allocation range rebalancing discussions. So, you want to grab them?
Just internal. Just
Tweak his words. You're right. Too late.
no, you can do it. Just before we go on, before everybody comes, I just want to introduce our new chairman of the board this year, pursuant to the annual election. So this year will be our Manhattan North trustee, Joe Strong, will be our chairman of the board, and will be coming to both the investment and the disability meetings. So,
Welcome.
Good morning.
All right.
Thank you.
He's going to make a difference.
Thank you, Dan.
it's a new day. He's pretty tall. Couldn't get him out of here fast. Make some money.
Look at the year-to-date review.
That's true.
Big table here.
Sorry, talk down this way.
Okay.
You want to introduce Larry? We can.
Absolutely. Great. Good morning, everyone. I'm Kathleen Dunlap with Barclays Capital. I'm responsible for the bank's relationship with large pension funds, and I'm delighted to introduce my colleague and friend, Larry Cantor. Larry is the head of research for Barclays Capital. He's responsible for the firm's global research. He's a member of our executive committee and our global partnership committee. Maybe going back to Larry's background, he started his career as an assistant professor of economics at Lehigh. From there, he went on to become an economist at the Federal Reserve. Then he was the chief economist for Europe at J.P. Morgan. Then he moved on to Normandy Asset Management. He spent 7 years there as the chief market strategist and economist. Then he went back to J.P. Morgan as the head of economics and market strategy before we were lucky enough to lure him over to our side. So with that introduction, I'll let Larry talk about the crisis in Europe and what it means to investors.
Sure. So I guess I'll talk for 20 minutes and then we'll do Q&A, or feel free to interrupt me if you want. This actually reminds me, earlier in my career, I used to brief the board. And I think the board table is about this length in Washington. Back then, the chairman used to sit way there, and they actually have microphones in the table, which I guess they don't have here.
No, they do, believe me.
They do here?
Yeah, they're right there, yeah.
Oh, they do? Okay, yes. And but they actually, when I was doing it, the chairman was on this end and the briefer was there, and in between was the other governors and the sort of heads of the reserve banks. And now they've changed it, so they now, somewhere in Greenspan, so the chairman now sits there, and the briefer's there, which makes it a little less intimidating. But anyway, so
We'll just make it more intimidating. Just remember, half this room is armed, by the way.
Yeah, don't kill the messenger. So I was asked to speak about the European debt crisis. There's a lot of stuff to talk about, but I'll stick to that. But I'm happy to answer questions on anything, the economy or whatever. It's kind of hard to do it in 20 minutes because it's pretty complicated. So I'll try to just put it, the sort of main elements here. And what I'd say is this whole crisis really exposes a flaw in the system that everybody actually knew about when monetary union was forming. I was based in London for a while. When I was with J.P. Morgan, I was the chief European economist. And when they were forming monetary union, everybody said, you can't have one currency, one interest rates, and different debt policies. And the response was, well, we've got this Maastricht Treaty and Stability Pact, and that was supposed to limit deficits relative to GDP to 3%. I don't know how familiar you are with this statistics. So Ireland's, the most recent statistic, their deficit to GDP ratio is about 30%. So they just missed that 3% limit. And the debt to GDP rate, so outstanding debt relative to GDP, was supposed to stay below 60%. Italy's is about 120%. So again, they're just a little off there. And, clearly these things weren't enforceable, and worse, in the case of Greece, they had been releasing numbers that were completely incorrect. They had to revise these numbers a few times. So we're in this crisis, and, it always... The other thing is, for 10 years or so, the thing was going on. It always takes some crisis to expose these flaws, and so it's now almost 2 years ago that this whole thing broke out, and we have been doing research at Barclays Capital, kind of deep dives on these countries, and to tell you the truth, from the very beginning, Greece really did stick out, and as being by far in the worst shape, and we came to a conclusion very early on that Greece wouldn't be able to pay this debt as it was currently structured. In other words, even on paper, we couldn't figure out any way that Greece could get back to a path toward fiscal sustainability in any reasonable amount of time. And there's a whole list of problems with Greece. I don't have time to go through all of them, but one is what I just mentioned. They have no credibility with the markets since they revised their numbers a few times. They have the structure of the economy it's just a mess. I mean, they have a very big public sector, and they have a huge underground economy, meaning kind of a simple way to say it is everybody works for the government and nobody pays taxes. But that's just one of many problems. And so it's, once you come to that conclusion, there's only two options. Either you bail them out with the bigger countries in Europe, or you have to restructure that debt in some way, which you could say that's a default. You have to either, lengthen maturities, reduce interest rates, maybe even forgive some principal. And that's that. And then in the middle, I would say, are countries like Ireland and Portugal, which, when you do the debt dynamics, are kind of close calls. It's possible that they can make it. We had always rated Ireland much higher than Portugal in terms of probability to make it. And for a long time, spreads on Ireland were actually wider than they were on Portugal. In other words, the market was assigning a higher probability that Portugal was going to get out of this without having to restructure than Ireland. And it has switched, so we made a good call on that. And the main reason is the Irish economy, one of the things when you do debt sustainability analysis, a critical thing, this is true for the United States too, is growth. And that's, again, another problem with the Greek economy because it's falling. When you're dealing with an economy that's not growing or worse, declining, it's just about an impossible situation because, if you raise taxes and cut spending, you're making the situation worse because you're already declining in terms of the revenue base, and so it's sort of like a black hole. So it's very important to establish growth before you start really addressing this. and the Greek economy is going down. The Irish economy is a very dynamic, competitive economy, a very big and competitive tech sector, pharmaceutical sector, and they're starting to show signs of actually growing their way out of it. So with all the bad news on Europe that you've seen in the last few months, the spreads on Irish debt have been narrowing. Which brings me to a point that I probably should put out now before I forget, and that is, if you're looking for anything, any sort of indicator to tell you what's really going on, look at the bond yields there. So one of the interesting things that's happened over the last month, so the last month, people, if you look at the newspapers, they're all saying, well, Europe's getting better, and that's why the markets are doing better. I have been taking issue with that. I actually don't think that's true at all. And if you look at the bond yields of the two most important countries that are involved in it, and that's Spain and Italy, and I'll explain why, the bond yields were doing nothing but going up. So Europe wasn't improving at all through the last few weeks. In my mind, and this is a little off the topic, I think markets have done better because the other thing that's been weighing on markets besides the European debt crisis is concerns about a double dip, a recession, that the economy was getting worse. And the news there in the last 6 weeks has actually been very good. Well, I shouldn't say very good, but so U.S. data, for example, show that not only is the U.S. not going into recession, but it's actually doing a bit better than it did in the first half of the year. The bar was low. I mean, the first half of the year GDP growth averaged less than 1%, so it's not saying much. But, for example, third quarter GDP came in at 2.5%. So, and all the indicators, whether it's jobless claims or capital goods orders or purchasing manager service, have all done better and are not showing weaknesses accumulating. And so my view is that's why the markets are doing better, because, and it's not just the United States, China, a whole bunch of places, the economic data have been getting better. Now, last week there was let me just say another thing about the framework, and then I'll go into sort of recent developments and where we're going here. Fortunately, and this is the good news, when you do apply the debt sustainability analysis to Italy and Spain. And by the way, at the end of the day, that's what's critical, is will they be able to ring fence Italy and Spain? In other words, prevent a restructuring, a default, or anything like that for Italy and Spain. Because Greece, Ireland, Portugal just aren't big enough to really cause another systemic global financial crisis. But Spain, and especially Italy, definitely are, to the point where the European financial system could not sustain a default of Italian debt. It's that big. So outstanding Italian debt is over $2.5 trillion. So Italy is the third most indebted country in the world after the United States and Japan, but has a much smaller economy, so much less ability to service that debt. So that is, and at the end of the day, critical. And that's, so the whole time since this crisis broke out, what I watch is these yields on Italian and Spanish bonds. And it's interesting because up until the summer, they may remain very well behaved. And by that I mean that they were at yields consistent with fiscal sustainability. So again, when we did the debt sustainability analysis, we concluded very early on and published this that Greeks would make, before the markets did. And the markets eventually got there, and Greek debt, even before last week, was selling for less than 50 cents on the dollar, appropriately, because they couldn't pay the debt back. Ireland and Portugal came out in the middle. Italy and Spain, by our reckoning, if they did the right things, in other words, pursued the right fiscal policies, and this is important, and were faced with financing rates that were low enough, they could make it. Now that last part, financing rates that are low enough, is particularly important for Italy, because Italy and Spain are a little bit different. Spain doesn't have a lot of outstanding debt, actually. Fortunately, coming into the global financial crisis, Spain had one of the lowest debt-to-GDP ratios in the developed world. It was below 40%. It's a hell of a lot better than the U.S., for example. Can you say hell of it? Anyway, it was thinking about it. Right? Heck of a, how's that? which it's by far the best in the developed world, and so Spain really didn't have a sovereign debt problem. The problem with Spain was more cyclical and related to the banks. So Spain had a very big boom and bust, and very much leveraged to the real estate sector, much like the United States and the UK. And furthermore, the banks, and it was these, not the big banks like Santander, but these small banks that are very similar to our savings banks, that we used to have all those savings banks, and very similar structure. If you remember the way the savings banks were before the savings and loan crisis, they were very much mortgage lenders, and so similar. And these banks, they call cajas, they're small S&L type institutions, and Spain had a massive real estate boom and bust, and these cajas had lots of losses, and the government is taking on that liability, and so that's Spain's problem. So Spain has a very big budget deficit, but their outstanding debt's not as big. Italy has the opposite. Italy actually, believe it or not, runs a primary budget surplus. What that means is if you exclude the interest payments they have to make on the debt, all the rest of their revenues actually exceed their expenditure. So Italy's actually made quite a bit of progress. The problem with Italy is they have such an enormous amount of outstanding debt that the cost of rolling that over is critical to debt sustainability analysis. Now, up until the summer, Spanish yields were about 5.5%. I'm talking 10-year here. And Italy was around 4 3/4. In the summer, these things blew out, and that's when I got really nervous that this thing was really spiraling out of control. Why did that happen? Everybody's got their own theory. My view is when the Germans started demanding what they call PSI, that's private sector involvement, in Greece, investors thought, hey, if they can do this with Greece, they could maybe do it with Italy and Spain. In other words, give that debt a haircut also for bond investors. And so investors, which were, one of the things that happened through this crisis, banks and other investors were reducing their exposure to these countries, but not Italy. Everybody thought Italy's too big to fail. No way. And so once they saw that, a lot of banks, hedge funds, and so forth said, I'm going to reduce my exposure. What does that do? You reduce the exposure, you raise the yield a little bit. What does that do? If you're a money manager, the implied probability that they're not going to make it goes up. And what are you going to do? You're going to reduce your exposure. See, so you get in this negative kind of death spiral, a self-fulfilling, where the yields start going up. So that started happening, I think it was early July. By mid-August, the yield on Italian debt had gone from 4 3/4 to over 6%. It was about 6.2. Which all of a sudden, our debt sustainability model started saying, Italy maybe doesn't make it. The ECB, European Central Bank, came in and started buying Italian and Spanish debt, actually brought the yield down below 5%. Right now, this morning, Italy went back over 6. So this is a situation we're in now. Again, the good news is it's not like the math's impossible. If you get the funding rates down, Italy can make it, assuming they do some of the reforms that Berlusconi keeps promising and doesn't deliver on. But assuming that happens, they actually can get through this. So let me just say a word about that, because that's very, very important. It's not like the mortgage crisis, because the mortgage crisis here, what happened in this country, just to simplify and make it quick, is there was all this outstanding mortgage debt, but a lot of the debt, and it was almost all the stuff that was originated starting in 2006. Very little bad mortgage debt was actually originated before 2006. It was at the very latter stages of the bubble, depended on house prices going up to make it good debt. And once house prices stopped going up, all of a sudden we had all this bad debt, and it just was bad debt. In other words, people could not pay this debt, and it was just a matter of who was going to sustain the loss and over what time period and how concentrated holdings were and stuff like that. But the loss was going to be there no matter what. That's not, thankfully, luckily, that's not the case. In other words, this debt can be good, and especially in the case of Italy, as long as financing rates stay reasonable. this whole situation, now, the other thing is, you might say, well, what's the solution here? How do you, so to solve the problem on a sustainable basis, what do you need? You need something, so what are the, you start with, well, what are the objectives? What do you have to achieve to make this work? You have to achieve basically two things. One is provide these countries with access to reasonable financing rates. I've just been sort of explaining that. But that's not good enough. It's tied to the second thing. Ultimately, at the end of the day, you have to instill confidence in investors that this debt is ultimately good. Because you're not going to get the reasonable financing unless investors believe at the end of the day Italy's going to make good on this debt, Spain's going to make good on this debt. So then the question is, well, how do you do something like that? And again, fortunately, there are solutions. We've actually written some stuff on that. I've even written some editorials on this, and that is, first of all, you need some kind of collective borrowing mechanism. Well, let me just step back for a second. I mean, you have a central monetary policy in the euro area, right? You got one interest rate, one body, one central bank, and one currency. The simplest solution is you just need one fiscal body for this, right? You need a central entity that collects taxes and allocates spending, and then you can do that. The problem is political. In other words, it's very clear that European countries are not willing to cede that degree of sovereignty to do that. So forget about that. Maybe in 50 years that'll happen, maybe even sooner. But it's not going to happen in the next few years. Fortunately, there's a sort of halfway solution that would do the trick, that would not require countries to cede that much sovereignty. And that is, instead of having all these different bond markets, you have the Italian bond market, the German bond market, the Spanish bond market, you have one big bond market. In other words, you borrow collectively. Now think about that. That would actually create a market that would rival in size and liquidity the U.S. Treasury market. It would be a huge market. GDP for the euro area is it's actually a little bigger than the United States. So you do that, and you need to guarantee that debt, just like the U.S. Treasury guarantees it by the governments. There's 17 that are in the euro area, guaranteed. But, and this is critical, to satisfy that would give you maybe the access to reasonable financing rates, but to make it work, you would need some quid pro quo. You would have to restrict access to this based on fiscal behavior. So you tell Italy, look, you can borrow up to 80% of GDP, not 120. In other words, give them a very strong incentive and you're on your own for the rest of it, which would be prohibitive borrowing rates, to get that debt. You see what I mean? There's no mechanism there. You need something like that. Now, the Germans have said we're not doing euro bonds. One reason is Bunds, those are the German bonds, yield below the average, and the yield on this would be presumably above the Germans, so the Germans don't like that. I don't want to get into too many details, but they've said no. You could, there's this European Stability Facility called the ESFS. You could construct that in a way, because they've just passed and given that new powers to buy bonds in the secondary market, and make that facility like a common borrow. You could use that and not call them euro bonds or whatever. But it's so there are ways to do this. The problem is really political. I mean, we all know we have some serious issues in this country in terms of agreeing on deficit plans and all that kind of stuff. You've got 17 different countries here, which makes it very, very difficult. And even to get this recent plan that they passed last week, it actually had to go through 17 different parliaments for approval before this. You got countries like Finland in there, Slovakia. I mean, it's, and by the way the rules work in the EU, it has to be unanimous. It's not majority. Every single country. So this greatly complicates things. I think at the end of the day, what's going to have to happen, to get anywhere near a sustainable framework is going to take forever. And remember, it took like 20 years to put the currency union together. I think in the interim, the ECB is going to have to go in there and just buy a whole bunch of bonds to buy the time and keep things reasonable and sustainable. Now, the ECB doesn't want to do this, and they say they're not going to do it, but I think they're going to have to do it, and that's what they're going to do. I think you will see in the next year and stuff, the ECB just going in there. They've already bought a whole bunch since the summer. I think, for example, they bought about 70 billion euro just in Italian bonds. Now, just to go over very recent events, so just last night, you may have seen the Greek Prime Minister. Well, okay. So I said before Greece isn't important, but that's a bit of a simplification because we do have a situation where Greece does have this debt and they can't pay it. And the problem there is, even though Greece isn't enough to bring down the system, there's two issues here that you do have to address and that are important. One is, while by our reckoning, the European banking system could sustain a default of Greece. In other words, that it's worth whatever, 50 cents on the dollar was the number they came up with last week. And that's basically in the ballpark. It's, depending on how many institutions have to get the haircut, you need somewhere between a 40 and 60% haircut. The problem is the Greek banks could not sustain that. In other words, the Greek banks have so much Greek government debt that they'd go under. Which means, now the problem there is, you might say, well, so what? But the problem there is that the Greek banks have plenty of interrelationships, loans, deposits, accounts, all kinds of stuff, with entities outside of Greece. And we all know after Lehman, you get some kind of domino type effect, and this can have very bad impact. So before doing that, they need a plan to do one of two things. Either recapitalize the Greek banks, which is the way they're going, put capital in to prevent this, or some kind of resolution authority, kind of like what the FDIC does here, where you wind down the institution and in an orderly fashion and assign liabilities to other institutions, stuff like that. The second problem is ring fencing Italy and Spain. In other words, investors seeing, hey, they just gave a 50% haircut to Greece, are going to say, maybe they're going to do this, and you get selling, which is exactly what's happening, by the way. Investors are selling Italy and Spain, and that's the big kahuna, that's the big problem. You've got to do something about that. The easiest thing is get the ECB to buy. Because the nice thing about central banks is they're independent authorities that can just make decisions. So tomorrow, the Fed could say, we're buying treasuries or we're buying Italian or whatever, and they do it. You don't need votes in parliaments. Well, you need votes within the central bank, but it's a very straightforward, quick thing. And the other nice thing about central banks is they can print money, so they can buy. Now, what happened last night is, after all this haggling and all this parliamentary approval and all this other stuff, they finally got to this plan to restructure Greek debt, which was a step forward. That was the big step forward. See, because up until now, in the last couple of years, what they've done for Greece not only hasn't helped, it's actually made the problem worse. So what happened is, see, right now, Greek bond yields are so high, they're prohibitive. Greece can't really go to the market. They're 10 years well over 20%. So, and they've got to keep the government running, pay workers, do all this stuff, and roll over bonds. So what's happened is the EU and the IMF have come in and just loaned them money. What does that do? Makes the debt even bigger so they can keep paying stuff. And then they come up with a new plan based on unrealistic economic assumptions, which the market doesn't buy because they're not credible, because the truth is Greece can't pay the debt. So finally, they did something more realistic, gave the haircut, et cetera, et cetera. That's a step forward because the markets like credible plans rather than fantasy plans. So that was this. It's kind of like what happened last week was definitely not an all clear signal because they didn't solve the big problems, Italy and Spain. It was kind of, the way I compare it, I don't know how many of you are football fans, it was kind of like they were on the 20, they got a first down, finally. And that was a good thing, but they still had another 70 yards to go to score, is the way I look at last week. Now what happened last night is basically the quarterback just got sacked. And now it's, first and 20. Because what happened is Papandreou, the Greek prime minister, said we're going to put this to a referendum. It's like after 17 governments approve all this, now he says Greece is not going to accept this. We're putting it to a referendum, which throws the whole thing back. And not only that, they're not doing the referendum until January. This just occurred last night. which is pretty amazing. And that throws up a whole bunch of questions. First of all, one of the plans last week was to attract outside investors. Not a bad idea, but the idea, hey, if you get the IMF in there, the Chinese, this is more doable. If you're the Chinese and you see this, you're like, there's no way I'm putting money into this thing. You've got, after all this, Greece now says they're going to have a referendum. What's going to stop Berlusconi to say, hey, on the next fiscal reforms, we'll have a referendum. Spain's going to have, we'll decide we're not going to do this. What if it's no? What does Europe do then, right? They're either faced with either Greece defaults on everything, or they have to have even a bigger balance. I mean, so what this makes it looks like, it just makes the whole process already difficult, even much more difficult by throwing this. Now, why did Papandreou do this? They do polls, the majority of the population are against it. He's got all these strikes and everything else. He figured, hey, I've just gotten a 50% discount on the debt we owe. Everybody will pass this, and they probably will. So he sees it as sort of a vote of confidence. It'll stem all the protests. Let's put it to a vote. They'll probably get it through. But this is happening in January. And so for Greece, for him, you can kind of see it. He gets a vote of confidence and all this. But it throws everything. I'm not even scratching the surface on all the problems this raises in trying to solve Europe's problem. Because now all kinds of other countries remember that currency union barely passed. Very few countries had referendums. Those that did either rejected it like Denmark, or those that passed it like France, it was by a razor-thin margin. So given all the problems they've had recently, the majority of the population in Europe probably wouldn't accept even the euro. Remember, the UK rejected it, and everybody said to the UK, you're going to really suffer not being in this thing. Believe me, they are so happy that they did not go into this thing. So, this is basically a big mess. Again, the good news is it's not like the mortgage. There is a way out. And again, the other good news is not just the Europeans, but everybody knows, U.S. officials, they can't afford to let Italy go. So I think they'll come to a solution, but I've been arguing this for a while. I think it's one of these things where things get worse before they get better. And there's a bunch of reasons for this. One is, and I was in Washington for the IMF World Bank meetings a month and a half ago, whenever it was. And what I got from European officials, I wound up, is just that, number one, they feel if they come out with the big bazooka now, the big rescue package, they won't be able to continue to put the pressure on Italy and Spain to do the right thing, which means things get worse first. And the second is more of a political reason. The Germans especially, the people do not support this whole bailout thing. So for her political survival, she's got to be the no person until things get so dire that she's seen as the person who sort of saves Europe. So there's also political reasons for that. So I think this is going to be a very stressful thing. It's going to be very volatile. It is affecting our markets. You just saw MF Global go down. And it's going to be back and forth. But I don't think we're going through another 2008 event. I do think they will reach a solution, but it's going to be very rough going and very turbulent over the next year or so until they get to a solution. So I guess I got to stop there.
I have a question.
Questions,
Sure.
yeah.
The obvious question is, in the event Italy and Spain do hit a default,
Yeah.
what's the impact here?
Yeah, so the impact here, the good news is, unlike the mortgage debt, the other thing about mortgage debt, it was incredibly broadly held. And there was so much leverage on top of it. I don't remember CDOs and CDO Square. And everybody had it. Japanese banks, German banks, everybody had a lot of this stuff, so it was a worldwide earthquake. The U.S. banks have very little European sovereign debt, almost none, actually. So that's good. There is indirect exposure through holding. European banks have a lot of it. And we have, our banks, and especially the money market mutual funds, have like commercial paper of the European banks. So there is that exposure. A lot of the pressure would come through the funding markets, and already there have been huge problems with banks in Europe not wanting to lend to one another. The good news there is that we just lived through this crisis in 2008, and a lot of it was short-term funding, and there were all kinds of programs, if you remember, one to bail out the money market mutual funds. There was a commercial paper program. The Fed had all kinds of liquidity facilities. So we would open those up very quickly, which I think would somewhat limit the damage. I didn't mention these pressures are hitting the European economy very heavily. So I think, actually, fourth quarter, the quarter we're in, GDP for the euro area is going to actually be negative. That's a problem, obviously, for our exporters here. And so it does hit our economy from that point of view. And I think the stock markets get hit on this. Look, it's hard to put a number on what the vulnerability is exactly, but one thing I would say is we are just not as vulnerable, and this is probably contrary to everything you read and hear, as we were in 2008. I'm always hearing analysts say how fragile things are. We're in a very weak economic recovery here, there's no doubt, and we can talk about reasons, I don't have time for why this recovery is so weak, but we're not very vulnerable to a recession right now. Why do I say that? You're vulnerable when the cyclical sectors are running very high, which they're not. Housing and autos are. Housing's at rock bottom, by the way. It can't go down. Activity, prices can go down, but activity is zero. It's been zero for 2 or 3 years, effectively. I'm talking about sales and housing starts and stuff like that. When valuations are overextended, you're vulnerable. They're not. They're, in fact, by almost any metric, they're sort of cheap, like stocks, for example. And when you see recessions are corrections for excessive behavior of some sort, and the correction wrenches those excesses out, and they're just right now. You think about it, the corporate sector, incredibly cautious. They're not hiring, they're not spending, tons of cash on the balance sheet, profit margins very wide. Investors, tons of money in cash and near cash assets. They're not overextended at all. Households, they've been paying down more debt than they've been taking on for 3 years. Their saving rates going from 0 to about 5.5%. So you're vulnerable when everybody's overextended. In other words, the stock market, in my view, is not going down 40, 50%. But if Europe really blew up, could it go down 20? Yes. But I'd be buying if it went down 20. That's the point. It's already low. But so there's some vulnerability there, but it's not. We're not looking at, in my view, another. Now, unless something else bad happened, and we live in a scary world today, I don't have to tell this group that. Something bad happens in Iran, and oil goes to one side. Then you could, you'll get a recession here for sure, that kind of thing. But that, you would need some negative exogenous event.
Can you dimension the size of the ECB balance sheet and how much more they can do before they get to U.S. Fed levels?
Okay, so good question. So the Fed has bought nearly $1.5 trillion of Treasuries, mortgage backs, and a little bit of agency debt, Freddie and Fannie debt. The ECB has bought, I'd say, a little north of $200 billion. It's ironic when you think about it. We all know we have a big budget deficit in this country and a lot of debt, but we don't have a debt crisis right now. In fact, the Treasury, we may get into one if we don't do something about it in the next few years, but the Treasury is funding itself more cheaply than it ever has. Investors can't get enough Treasuries, so we don't have it. And yet, the Fed has bought all these Treasuries, and the ECB's bought very little. So therefore, there is a lot of scope for them to do it. Now, I don't want to get into technicality because there is a big difference between the Fed and the ECB. The ECB actually has a capital structure, and there are limitations because they represent all these individual central banks, like the Bundesbank, Banque de France, and so forth, the central banks of the euro area countries. But those are things they could get around. I'll just say that. So there are technicalities. People point this out. They could buy a lot more. And in principle, by the way, I don't know if you know this, there is no limit. In other words, the Federal Reserve can buy as much as they want, and they can buy all kinds of stuff. They can buy used cars if they want. I mean, they choose not to, but so the central bank can print money. That's the thing. Now, there are consequences for that. It's consequences for everything. But they can do that.
And what do you think about the budget discussions in Washington, how that might affect everything else?
Yeah, so that's a good question. This thing that happened in the summer was very discouraging, I would say. Maybe you'd all agree. Yeah, I don't think anybody came out looking too great in that thing, whether it was the White House, the Democrats, the Republicans. But it was kind of a manufactured crisis, because what they did was they attached a serious issue like debt and deficit reduction to kind of a technical issue that happens to be time sensitive, and that's raising the debt ceiling, which they do all the time. And this created this whole crisis. If you look through the nasty politics and rhetoric and how bad it looked, and the fact that S&P ended up downgrading U.S. debt, there was actually progress. In other words, 6 months ago, actually, everybody thought debt and deficit reduction was going to occur after the election. Nobody was really talking about it. They already lopped off nearly $1 trillion from the baseline over the next 10 years, and before the end of the year, they're going to have to lop off another over $1 trillion, actually, which is progress. And tax reform's on the agenda. Everybody's now talking tax reform. Nobody was talking about it 6 months ago, which is a good thing. Now, they have different versions of it, but the commonality is all of it is broader base, lower rates, which any economist will tell you is a good thing. Now, they disagree on how to broaden the base, what should be exempt and what shouldn't, and so forth, and who should pay the lower tax rates and all that stuff. But they agree that we need tax reform, which is a good thing. I'm not a political expert, but I would be surprised if they didn't figure out some way, this super committee, of getting through this thing so they didn't redo the summer, because they all came off looking so badly. So I think they will agree on something. It'll probably contain an element, in my view, of kicking the can down the road, so to speak, which is not great, but it's better than no agreement and disaster. What do I mean by that? I actually think what they're going to end up doing is saying, yeah, we agree on the cuts, but we're going to assign the work to various committees. So the Agricultural Committee is going to have to come up with this, and the Defense Committee, you know what I mean? So they don't do it. And they say, so I think there are ways, and I'm hearing, we have people in Washington who are saying there are ways for the committee to sort of get an agreement so they don't have to do this across-the-board thing. And not cause a crisis in this thing. But still, we don't really get any real decisions till down the road. The other thing you should keep note of, all these cuts they're talking about, it's not for this year, and it's not for 2012. Even the provision where if the committee does not come to an agreement and you get the automatic, I think it's $1.5 trillion, that starts in 2013. A lot of people don't know that. So it's not going to hit right away anyway, and that's plenty of time for Congress to do some other things. So I think the risk here, in terms of the fall, is much more about confidence and the news you hear and all that, because it did dent confidence, this whole thing in the summer. People were worried the U.S. was going to default, which was never a realistic prospect, but people were concerned about it. And I think it affected firm hiring behavior and things like that. And so, anyway. Well, I hope that was helpful. Thanks for your attention.
So Europe's in the cracker for now.
I would say we've been advising stay away from
Exactly.
equities there, debt there. It's a mess. Like all things, look, the U.S. stock market has massively outperformed the European stock market, and rightly so. And what that means is if you do get something like a solution, the upside is much bigger there. So European financials, for example, have gotten absolutely hammered. And if you get to progress to a sustainable, like last week when they did this thing, they thought they made progress on Greece. That went up the most, the European financials, because they've gotten killed the most. They hold a lot of this stuff. So that's the caveat. You really have to watch things carefully to see whether there's. At the end of the day, to simplify this whole thing, when you start seeing investors buying Italian and Spanish debt, you've got that's what you need to say. To think there's really a solution. So far, any rallies have just been the ECB buying. It's not investors. Barclays just reported results yesterday, and it showed we had reduced our exposure to Italian, Spanish, by a lot, and everybody's doing that. So, anyway.
Anything else?
Thank you. Thanks a lot.
Thanks for having us.
An uplifting way to start the morning. You did it very well, Joe. It's in the graph.
That's in the graph.
Okay, so let's look at our monthly performance. This is a good month. Everybody have one? I'm going to skip the section on the economy since we sort of highlighted that. So I'm going to get you to start. Let's start on page 21. Remember, these are the September results, right? And this is November. So if you look what happened in the VIX, which is the volatility in the U.S. stock markets, so that's on the market's direction. Since August, it's been extremely volatile time, right? And 70% of our portfolio is equity related, 60% in the public market. Lots of volatility. The next page shows you the Fed has tried in this Operation Twist to drop lower rates, long-term rates. So if you look at the white line, the white is today's yield curve, and if you compare that to, I guess it's
White or the green?
No, the green, right?
I'm sorry, the green. If you take the green line and compare it to what looks like, I guess, a purpley line, which was a year ago, or December, you see it's dropped. And again, the Fed initially concentrated on the shorter end, now they're concentrating on the longer end, all of which is to drop long-term rates. Drop long-term rates, you can maybe kickstart the housing market, and you can force people to do riskier things like get back into the stock market. So they're pushing as hard as they can. They're back to buying billions and billions of dollars of bonds, and we'll see. But again, it's a little bit in a bubble because we just talked about there's an awful lot going on in Europe. But that had the effect on the next page, page 23, of taking rates down. But then again, the U.S. bonds are now very, very wrapped into what's going on in Europe. So people panic about what happens in Europe. Everybody rushes to U.S. bonds. When things get calm, they sell the bonds and they put the money probably back in the stock market. So there's this real triangle that I'm afraid has been bouncing around, day to day. I mean, for instance, this new thing with the Greek referendum, out of the blue. So markets felt good the last couple of days. Now they're in the crapper again. Very treacherous markets. The next page, 24, are the spreads. This is the premium for risk. The blue line is the high yield index. Recall that when it was near the bottom, we sold. So low rates is high prices. So we sold a lot. Now rates are moving back up, and I'll get back to what we're sort of working on. But you can see rates and spreads have really backed up because people are afraid, so they charge more for risk. So the risk premiums are coming back because really there's no right answers now. So the answer is be afraid. The next page, page 25. If you look at the blue line, which is PE ratio of the S&P, pretty cheap. 13 is pretty cheap. It's normally around 15-ish. So stocks are cheap, but people are petrified to touch them. The next page, 26, the blue line is partly why stocks are cheap. The blue line is the current, where are we relative to when the recession ended. Corporate profits are way up. Partly they're way up because people have been fired. So the bad news is they've been fired. The good news is corporate profits are up. So if your stock price stays the same, your PE sort of comes down, so things are cheaper. At the same time, we don't have a lot of corporate debt issues, and there's an awful lot of cash on people's balance sheets because they're not quite sure what to do. Should they make acquisitions? Should they invest in new capital projects? So our corporate America, if you will, is in very, very good shape, which is good news for whenever things calm down. If you go to the next page, page 27, these are the PEs of the U.S., EFA, and the markets. And again, they're all pretty cheap. There's an error on the first one. The Russell 3000 not selling at 1.2 times earnings. That would be a real problem. But it's selling around 11-ish, but it's cheap. Similarly, if you go to the next page, you can see large, mid, and small cap. Again, the same kind of things. U.S. stock market is not expensive, but having said that, awful lot of people would rather go to the sidelines, be in cash, or treasury. Here you can see on 29 the markets. I draw your real attention to the top white line. See this sort of seesaw up and down? This is really the U.S. stock market reacting to what's going on in Europe. And actually the drop was really what went on in the U.S. Debt ceiling. As Larry Cantor was referring to, that whole thing with the debt ceiling freaked everybody out, stock market tanked. And then after that, it's really been going up and down with the news coming out of Europe. So, for instance, yesterday, it sort of crept into the market toward the end of the day. What Papadandreou was doing over in Greece, the market was down 2.5%. It's down 2% again today. If you go back to last week, everybody, hooray, hooray, it was up 3% on Thursday. This is really not at all what you want as a long-term investor, to kind of watch markets bounce up and down like this. It's not good for capital formation, and it's extremely treacherous. So again, the white line is the U.S. stock market, the blue line is IFA, and the red line is emerging markets. You know, at some point these things are cheap, so it's really a question of when do you feel good about taking a longer-term view, saying, you know, it's all right, let's go make a few investments because we're long-term investors. That gets us to where's the police pension fund assets. If you look on page 31, again, this is 10 years. You can see the fiscal year end was about the peak, $24.6 billion. And at the end of September, it's down to 22.3. But I would tell you to just jump to page 37 for a second. Embedded in that number is, if we look at the top two blocks of numbers of 1 month trailing, the U.S. stock market down 8 to 10%, and the IFA and emerging markets down, 10 to 13, 14%. Those numbers are embedded in your September number. So it's like, again, think in those sawtooths. The mark of September 30 is one of those bottoms. So what happened in October, which we'll look at next month, U.S. equities are up 11%, IFA is up 9.5%, emerging markets is up 13%. So this picture here is kind of at the bottom. Next picture is kind of up again. Who knows where the rest goes? It's still going to bounce around. So if I were to tell you that as of sort of the close of October, the number is really closer to $23.5 billion. So again, our numbers are going to start having a sawtooth effect, just like the markets are. It's pretty weird, but it's just the way it is. So yes, we were down 9.6 for the quarter. I don't think we'll be that much different than any other large pension fund, down about 9, 10, 11, depending on what you did. And again, we're up in October, and the first day we're down 2% again in November. What we have been doing, as we've been talking about in the past, if you go to page 33, we have not been reinvesting cash. We've been sitting on the cash. So we've been building cash, partly because we have this asset reallocation that I guess we approved in June probably. So we're starting to set some things up, and then the markets fell apart in probably August. So we took a little more money out. We actually timed it pretty well relative to these sawtooths. So at the end of September, we had 8.8%, and we've now actually put some back in the markets. So now we actually, if you look at it today, we only have about 6.7% cash. We've since bought some high-yield bonds, and we've since bought a little bit of emerging market equities. But again, we're trying to get from page 33 to page 34. 33 is the old asset allocation. 34 are these bands. We're going to talk about how wide the band should be in a minute. These bands are trying to show you where we're trying to get to. So again, if you look, we're kind of okay in the U.S. stock market. We're okay in IFA. We're a little light in emerging markets, which is the brown. And again, we just bought 0.5%, so we're kind of back in. We're getting close to that. We're under-allocated in hedge funds because Seema and her team are working on the first direct hedge funds. We're going to come back to you next month or in December and probably have about 1.4% in hedge funds. We're going to come to you with 3 recommendations. So that'll slowly start working. We've added, as I mentioned, to high-yield bonds because if you go back to that spread curve, the high-yield bonds have spiked up. So the yields are back up. So we sold when they were too expensive. Now they're backing back up. So we're kind of getting ourselves back in. So now we just bought about 1.3%. We're probably right on the new asset allocation for high-yield bonds. We're also working on this, I guess it's a chartreuse number, for lack of a better way to call it, this thing that says down 3.9%, which is the opportunistic fixed income. And if you remember, we've been approving a variety of managers.
See, I would have said hot paint. You do chartreuse.
I have more crayons in my pocket.
She had the 128 pack.
We've approved about 2.5% in the 5 or 6 market managers.
Oh, that's right.
5 or 6 managers, and we're in the documentation phase of that, so they can't put the money out. So we've been either sitting on the cash or slowly moving into high-yield bonds, which is where they're going to go. So this is going to be moving up and getting in line. So again, to make a very, very complex asset allocation in a very turbulent waters, we probably have more cash than we would have ever planned for, but it's trying to get onto this page. And not every time, and as we're doing this, the markets are just insanely turbulent. So I think we're doing the right thing by having the cash. We're putting it out the way we're supposed to. By our guesstimate, assuming the market just calms down a little, we should have virtually all of it invested by year end, all the cash back down. But again, if the markets stay the way they are, we're just not going to put money in wildly erratic markets just to say, check a box and say, now we've done the asset allocation. Because again, if you think about the asset allocation, I look at you, Barry, when you switch asset allocations, and our asset allocation, I think, had us moving about 30 points of assets around. When you add something to this and take something away from that. We normally would do that over 12 months.
Minimum.
Yeah, minimum 12 to 18 months. So some of the stuff is, well, minimum of 12. But it is interesting that where we are, there are some opportunities created by this. I mean, to the extent the high yield market was on fire before, good time to sell. It's now getting frozen. For instance, we'll put more of it into that, which was again the opportunistic fixed income strategy that we embarked on. So I think we're headed in the right spot, but these markets are just ridiculously treacherous. This is all I can tell you. Just when you thought it was safe to come out again, they pop you over the head. So that's where we're on the asset allocation. In process, complex markets. So we're not in a rush because again, as you just said, Barry, 12 months would be normal. There's some opportunities. We're a little bit trying to be optimistic in the opportunities, but again, we're just not in a hurry. But again, this snapshot here, the peak is now 6.7%. It's probably heading south, but again, they're about to blow things up again in Europe. There's really no rush to do that. And it has been an anchor to, again, as you see in this October, to the extent we had that much cash, we didn't go down that much because you had this cash that was sitting there instead of dropping like a rock. So that's the asset allocation.
So, Larry, can I ask you a question?
Yeah.
On the page 21, you have the chart on the VIX. And I can't help but noticing that it goes, in the last 30 days, it goes up 50%, and now it's gone down 50% and up 50%. Is that you think that's, what kind of an indicator do you think that is for the market? Is that an indicator that the market's going to have a swoon? Or just does it?
It's anxious. It's just anxiety. Nothing more complicated. I watch this, and I watch the 10-year Treasury and the 30-year Treasury, and if I had just a few numbers to look at. Mm-hmm. So, for instance, and if you look at the 10-year Treasury, which is, if you look at it here, it kind of mirrors a little bit. It's on page 23. It mirrors a little bit the VIX. The bottom of the 10-year Treasury was like 186. That's a pretty ridiculous number for a 10-year bond, 186. But it went from 186, middle of last week it was at 230, and that span was probably 2 weeks, 3 weeks, and now it's down to like 206 or something. That's huge price. If you think about it on a price base, that's up 10%, down 10%. That's people saying, I'm worried, I'm not worried. I'm worried, I'm not worried, because you have an awful lot of people, like us, that are husbanding their cash. And when you think it's safe, you want to put some money out. And then when it's not safe, you want to take your money back. So that leads to this kind of volatility in the VIX. And again, if you look at the very, very end of it, that was when, think of the stock market again going like this. So when it calms down, people look at the stock market values and say they're cheap. Let's put it in. For God's sakes, when it starts to go down like today, 2.5% today, 2.5%, yes, that's 5% for 2 days. So everyone says, I got to get out. So it's a terrible time to be a long-term investor or a short-term trader. I mean, don't forget, all of our money is outsourced to money managers. So their volatility, their bonus pool, their careers are on the line. So you end up perhaps going long, short, very complicated time. Seema, you want to comment on the VIX at all?
I would just also add that there are a lot of those program traders out there too that's creating a lot more volatility in the markets, which you didn't have really 5, even 10 years ago. A lot of, even to Larry's point about long-short equity managers, they've been getting crushed because, they think, all right, market's getting better, I better go more long. And then the markets collapse, and then they think, oh my God, I better reduce my exposure. And they're getting bounced all around, and their performance has been the worst so far this year of all the hedge fund strategies. So it's a very difficult time. I think we're probably going to see some funds by the end of the year in the hedge fund world shut down, just because it's been so difficult for even very talented managers to make it through this year.
Roy, this is a very important conversation for us to have as a board. Because I look at this and I say, the trend about this chart is that it's mean reverting. Meaning we can stay really high and you don't know what keeps it high. There's a lot of fear, so the markets are not trading on fundamentals. They're trading on fear, they're trading on anxiety. They could as easily revert back. So it could markets are down a lot, they could go up a lot. When you're in this high vol period, there's just no way to pretend you actually know something, because you don't.
So the information is not built into the market.
That's what I think.
So then, therefore, all the models that we're taught don't really work here.
Well, think of what
because
you
that's
just
the idea.
said, that these great guys who call directions.
Right, but that's the idea, that everybody has the information and the markets will react to what the information, and it's all built in. But if you're saying that no one has the right information, because they can revert very quickly, and there's no real, you have programmatic traders out there countering what should be basic knowledge, and things are going well somewhere and they should go long, but now they're not because they're trading on the volatility. So the question we have here is then, the models we all are taught don't seem to be working. So what's the real answer to that?
The way I would characterize it is, and Larry said what Larry said. Larry said it's a very difficult time to be a long-term or a short-term investor. I look at this, it's a great time to be a long-term investor. Because we're not sitting here trying to call it for the next 30 days. We are the patient capital. So we don't want to invest money that we have committed, because in this volatility we can't afford to lose half of it. But in terms of making a market call, based on what? We don't know. And so our policy portfolio is what you go back to at a time like this and say, what we do believe is that in the long term fundamentals reassert. And fundamentals is what we invest based on. Otherwise we would not have equities and bonds, and we would pretend that this diversification stuff doesn't really work.
So we have to have faith. Faith in our investment policy.
Faith in the equity risk premium still exists. Faith that some of the things, faith in the negative too, that some of the things that are happening on the policy front are likely to lead to bad bond yields for a long time, that the fear is driving people into the liquidity trade, and so the artificial low in bond yields, Mr. North, is not something we extrapolate for the next 20 years. But in other words, faith simply that fundamentals is what the market will come back to trading on. I'm not saying in 6 months, I don't know.
Did I feel a brushback pitch somewhere? Is that a little bit of a headshot
Just
there?
pulling him into the conversation.
Little chin music on that one?
Don't worry, the home runs come after the brushback.
Oh, boy.
The good news is I didn't get the sports metaphor, but Joe will tell me later. Gary, would you agree?
I would tend to agree. The VIX is telling you sort of what the cost of buying options is currently in the market. And it's a measure of volatility. But it's a measure of implied volatility, what investors think it's going to be over next 30 days, next 90 days. If you go back in history and compare what the VIX said the volatility was going to be to what the actual volatility was, the VIX is almost always higher. Which is, to put that in simple English, I think we've all become oversensitized to volatility. And the way I like to look at it is, let's just call volatility the percentage of days that the market moves more than 1%, up or down. Okay, a simple definition of volatility. In 2011, that's happened about 31% of the trading days, or about 1.5 days out of each week. Over the last 5 years, that's been 40%. So we're actually lower volatility than what we've seen in the last 5 years. And if you go back to 1930, that number's 23%. So we're at 31, 23, and if you consider all the weapons of mass destruction that are available to traders today, and I particularly mean leveraged ETFs, where you can bet 3 times the market up or down, I don't think it's that nasty. I really don't. I think it's sort of a sort of normal type of volatility. Now, I have to couch that because if you say, what's the percent of days the market has moved more than 3%, it's a pretty high number. So if you change your definition, you get a different answer. But I sort of like the 1% definition.
And statistically, aren't those events supposed to happen like once every 10,000 years?
But they happen more and more frequently.
And they're happening more and more frequently.
That's correct.
That's the fear.
Right.
Okay.
But you can make money shorting the VIX and buying real volatility, realized volatility. And there are hedge funds out there that do that.
It's a very scary strategy.
Yeah, I wouldn't recommend it. I certainly wouldn't recommend it.
I mean, when we hear some managers say stuff like that, we step back a little bit.
Good.
So can I catch you to page 36? So what's happened to us? So again, this is September. So for the month we lost 5%. For the fiscal year we're down 9.6%. And again, the market was up. The U.S. equities are up 11 in October, and 9.5 in EFA, and 13 in emerging markets, and 5 in high yield in October. And I would bet you we probably bought back at half of this in October. But again, this is a month to month, and we're trying to make believe we're investing for 30 years. So a little more volatility in our lives. It's going to be a good month or a bad month. I think it's an interesting time to be an investor, actually, because in the long run, I think this is you're near a good place to make long-term investments. Who knows when they catch it? It's not our job to pick the bottoms. But again, I think we're probably down less than 5% fiscal year to date through October, which I think is actually not so bad given all the volatility that we just talked about. What does start to happen when you get a little further into this is you'll see, if you look at the managers, there's just more people going to be read off the indexes. As Seema said, this is a hard time to be a real money manager. That you have your face in front of a screen, trading stuff. So I don't take too much of what happened in the month of September when the market was down 10%. These others, they were green, but there's more reds than usual. I presume it'll balance out because our manager's skilled, but we'll see. Time will tell. Seema, do you want to have any comments on the equity manager?
No.
No. Martin?
I have some comments for specific managers, and we'll talk about that in the executive session.
Barry?
Nope. So,
Barry. Yvonne? No. All right, so that's the report for the first quarter then. Down less than 10, probably have it back in October. Stay tuned. Don't believe everything you read in the newspapers. So if there's no questions on this, the next item is asset allocation, balancing ranges, and I'll turn over to Barry. Camera right there.
Okay. All right. So in July, we approved asset allocation targets at the 25% basket level, which is appropriate today. It may change later in the future, but this analysis is based on that allocation scheme. And of the major things we do with asset allocation policy, this is the last effort we have to go through. Once we get this settled, we're good for a little while at least. So why do you rebalance? Well, if you assume that our asset allocation policy adopts the optimal position to fund pension liabilities at a reasonable cost, then moving away from those targets creates an unintended risk, and you probably should avoid it. However, rebalancing constantly incurs a transaction cost that you want to avoid. Therefore, our rebalancing ranges are based on a trade-off between this cost, transaction cost, and the opportunity cost of not being at your target. And, market timing in itself has been proven to be very difficult. And that's just for a day trader or an individual. If you put that into the context of prudent pension fund governance, where obviously the board is in charge of policy, but when you get into implementation of policy, there are some mixed responsibilities between the board, BAM, and actually the managers, the rate at which they call capital, then it becomes even trickier. So, moving to the next page, you see the target allocations at the 25% basket level that were adopted in July. Now, this is a preview of what we're getting into, a preview of what we're going to be suggesting. But if you look at this page and you say there's 11 asset classes, and I want to make the point that this is the biggest number crunching exercise that we go through. And just think of all the number crunching we have to go through to get to this result. You have to come up with estimated trading costs for all 11, buying and selling, and you have to come up with correlation estimates of one asset class against the other 10 combined. It's a very complex set of data crunching, but yet it's fairly intuitive and commonsensical. So I think you might want to say to us, isn't there some sort of magic formula regarding rebalancing ranges and frequencies that we should just adopt that'll give us the best risk-adjusted return no matter what the environment? And the answer is no. We've back-tested just about every combination of width of the ranges, how often you do it, when you do it, and at what trigger point, how far do you go back? Do you go back all the way to your policy or halfway back? And the truth is there's no magic formula. Every backtest is very time-dependent. For instance, if markets tend to trend for a very long period of time, you don't want to rebalance. You want to stay with your winners or let your losers sink in their weight sink in the portfolio. However, if you enter choppier markets, you want to be rebalancing all the time. And we're not sure what the market's going to be in the future, so none of these PAT policies work all the time. Therefore, when we come to our procedure to getting to a range, it's simply a trade-off between the cost of rebalancing and the opportunity cost of not rebalancing. Sounds like a simple trade-off. In order to do it, you have to define a utility curve, which is the hard part, but I'll get into that in a second. So page 5 is the result, and we'll get in following this of how we got to the results. So for instance, domestic equities can stray 4% from their range from their target before there's a mandatory rebalancing, and so on. We'll go through each one. At the bottom, you see we've established some group constraints. You don't want all your equity asset classes to be at their max or minimum at one time, so you have a group constraint that's narrower than the sum of the width of all the equity bands. Same for the fixed income portfolios. And then we also designate some parking places, but for lack of a better word, we'll call them parking places, for certain asset classes that are not up to their target and are going to take a while to get there. Those would be absolute return, the opportunistic fixed income, and the real estate. For private equity, we're basically at our allocation rate target at this point in time. So for absolute return, we've suggested 60% U.S. stocks, 40% the core plus 5. How did we get there? Well, we have a 6.5% expected return for the hedge funds and 8.3 for the domestic equities and 3.1 for the domestic fixed income. I'm sorry, 3.8 for the domestic fixed income. So that makes you about 60-40 to get there. For the opportunistic, we're saying 80% core, 20% high yield. If you want it to be more like the opportunistic fixed income, you might go 100% high yield. Our thinking in weighting 80% to the core is that in high yield, transaction costs go through the roof when you get into a rough patch. And because the intention is to fill up this opportunistic bucket in a pretty fast manner, and that's been the path we've been on, we don't want to be in a position where our transaction costs eat up the higher expected return you see in high yield. So we're suggesting a higher weight in the more liquid, lower trading cost fixed income assets. And for real estate, it's a combination of a real estate vehicle and an inflation hedge. When you buy REITs instead of direct private properties, you get a lot of market sentiment into the return stream of a REIT. So we wanted to have a cushion there with the tips. Okay, now let's get into the science of the rebalancing on the next page. We've made estimates on trading costs. So you have to estimate what it costs to sell an asset class and buy an asset class. And to get those, we use the average of the academic studies we could get our hands on. We're not trying to reinvent the wheel here. We're reading other people's studies, and we're saying, let's just take an average of those studies. But when you buy or sell an asset class, you also have to buy or sell something else in the portfolio. So we're assuming we're buying the whole portfolio x the asset class that is outside of its boundary. So there's actually 4 different estimates you have to make in estimating overall transaction costs.
And the portfolio is weighted by our new policy?
Yes. So I would group these sort of into 3 buckets. There's sort of cheap asset classes to transact in. Those would be the TIPS, the absolute return, the U.S. fixed income, international stocks, and domestic stocks. Then we have a sort of a middle tier, which includes emerging markets, high yield, and the opportunistic fixed income. And then we have a very expensive tier to transact in, which would be the real estate asset classes and the private equity. And you don't want to be shuffling those around a lot because you will definitely eat up your opportunity cost in transaction costs.
Then why have rebalancing ranges? I understand that we have investment ranges, but we don't actually rebalance real estate and private equity. Or we don't intend to really rebalance opportunistic fixed income. So I agree that we're not going to get invested and we may need an that maybe this reflects just that we can't get invested or the denominator effect and sometimes we'll be higher than we planned to. But should we even have rebalancing ranges?
Well, we do have mechanisms to transact in those asset classes. But I've sort of agreed with you, and we've set those ranges at 2 times the target. So let's say that, say the private equity, the target is 7%, and we can go as low as 4 or as high as 10. So a 3% move each way. So those asset classes would have to move about 50% differently than the rest of the portfolio before something got triggered. Those are pretty wide ranges around low absolute allocations. They require huge moves to get to. And you may not want to. I agree. And I also say that when you're within that range, you should leave it up to BAM doing best efforts to keep moving towards the target. And I don't know, you may want to not have them. In the past, we haven't had them. But I think they should be, if you have them at all, they should be very wide.
In the past, for private equity, it was a point, it was a number, which isn't useful to manage to a number, because a number, you can't get to a number.
Oh, but we've been outside, correct? And
No, not
when we had the 08, 09, we were well above because of the denominator.
Right, but then that's when you have a board conversation, what are you going to do about that?
Right, and we did nothing, which is right.
But it's useful to have ranges on the illiquid assets just for pacing. For getting to the...
Well, let's call it a
if you get-
pacing range. I just don't want to put something in there as a rebalancing range when we're actually not going to buy and sell this, and we don't want, as a board, to encourage you to think about it that way, but as a pacing mechanism, as a commitment mechanism, I think that's a different conversation.
It is a pacing mechanism. I mean,
Right.
the management of it isn't rebalancing, it's pacing. That's really the practical implication of it. Because the way Barry has it set up, if you ever got to those wide ranges, you could have a lot of conversations with the board as to how do we get here, what we're going to do about it, if anything. So it wouldn't be just BAM doing it because of the breadth of the range. It's kind of that's the way it's got to
And actually, if we followed our model, those ranges would even be wider on those 3 asset classes. We just said we have to have some sort of range, so we set it at 2 times. That was arbitrary, 2 times the weight.
I think part of this is an IPS rewrite, and just is how we put the words in to describe what we just said.
Yeah.
Okay, so we know what I'm on the next page now. We know what the transaction cost is, but what is this thing called opportunity cost? And we sort of define it on this page. So let's say you have a 34% target for equities, and you get up to 38. Now, that's probably going to mean you're underweight someplace, probably in fixed income, 4% underweight. So you naturally have a higher expected return because there's a higher expected return assigned to equities than fixed income. We're saying that the hurdle rate is not the expected return, but the required return. So when you take more equities than your policy calls for, you're actually taking on more risk in your policy. So that hurdle rate is the difference between the required return to compensate for that risk and the expected return that you get naturally from being overweighted in equities. And we go through that.
Said another way, if you were to be underweight equities 5% relative to being underweight bonds, relative to what we want in our policy portfolio, what we want the policy portfolio to do, it's much more risky and expensive to have that equity.
That's right. Mhm. And that's calibrated for each asset class.
But then on the upside, if you're overweight, it's actually pro the policy target.
That's right. And it is symmetric. So, starting with the next page, we just see how you're expected, and we're just focusing on domestic equities here as an example. We've actually done this for each asset class. You know, how much is the expected return by being overweight relative to your 34% target or underweight? However, on the next page, we put in a new line, and that's that curved light gray line. and that's what we call a utility function, which also incorporates the risk of being overweight or underweight in your portfolio. And over on the right, you say, when you're overweight, here's how much extra return you can expect. To the right of that, we're saying the utility curve is defining how much you need to overcome the risk of being overweight. And it's the difference between those two lines that defines the opportunity cost. So, now again, just focusing on the next page, just focusing on U.S. equities. We start out at the bottom of the page at our target weight of 34%. You're on target, there's no opportunity cost, no transaction cost. If you go to 35%, should you rebalance? What you get from rebalancing is 1/10 of 1 basis point, but it's going to cost you 7/10 of 1 basis point across the portfolio to do it. So you don't trigger a rebalance 1% off. At 2%, you still don't. You have to get up to 5% off your target, where it still costs you 7/10 of 1 basis point in transaction costs, but your opportunity cost has moved up to 9/10 of 1 basis point. That's where you cross the line. So we've set our rebalancing target for domestic equities at plus or minus 4%. We don't want to cross that line, and that's how we do it. And if you go to the next page, you get the our recommended rebalancing ranges. You also have to take into effect how big the nominal target is, because you're really computing a percent move from a bigger base. And you'll see that some relative to the base, some of the ranges are wide, some are fairly narrow. Well, how do we get narrow or wide ranges? And that's where the common sense starts to come into play. On the next page, we compute the correlation of the asset class to the other 10 asset classes in combinations weighted by the policy. Interesting page. If you only invested in one asset, but wanted the risk-return properties of the total portfolio, this says you'd put it all in high yield. It sort of makes sense, sort of a combination of stocks and bonds. So the high yield has a fairly wide range because being off your target doesn't disturb the total risk-return properties of the fund. Down at the bottom, you see TIPS. Has the lowest correlation with the rest of the portfolio. So you want sort of a tight range around something like that. And it tells you something about TIPS. It's a great diversifier to the rest of the portfolio. And if you look at the performance results, that speaks itself in volumes. So that's one of the key inputs. How does that asset class relate to the rest of the portfolio?
I'm really surprised at private equity. Over time,
I mean that it's so high?
is it just an accounting thing because it doesn't show volatility historically?
Well, our proxy for private equity is a post-venture series. So it's a publicly traded index of IPOs.
So it's the correlation with RAS being so low that I was remarking on.
We also see on the next page that those that have high asset classes, or high transaction costs, you don't want to rebalance frequently because it's very expensive. So those with the highest expenses to rebalance also have the widest ranges. Those that are very cheap, like TIPS, have low expenses. The next page is to your point, Ranji, that if we went through the model, some of these asset classes had such a wide range that we cap the range at 2 times the target. And that's true of the core real estate and the opportunistic real estate. Those are the ones that's, and the opportunistic fixed income. Those are the ones that really stand out. Just a couple of simple observations and common sense observations. The illiquid asset classes have wide ranges, so in effect, we're depending on BAM to, when they're near their range, instead of rebalancing, or even in cases where they might exceed their range, just to work as hard as you can at a reasonable time and prudent procedure to get those asset classes closer to target. And then we also put group constraints to avoid the situation where all sub-asset types are at their max or min. A tighter boundary, we chose plus or minus 5%, which is, by the way, the existing policy today.
Barry, quick question on emerging market equities.
Yes.
Just the bands there seem a bit tight to me, given the kind of volatility those markets experience. Whereas we may be out of range pretty quickly, and it could snap back. Or so I'm just curious how you thought about that.
Well, there's a volatility estimate that's going into these bands as well. So if you look with emerging market stocks, the target is 6, and the min-max is 4 and 8, so plus or minus 2%. So that means there's a relative move relative to the rest of the portfolio of 33% performance differential. So I would argue that that's not really a tight band. That's giving it quite a bit of leeway.
Well, we hit 28% just like 3 weeks ago.
Yes, and you rebalanced.
Correct.
Okay. I rest my case.
Okay. It happened so quick. I don't know.
It's expensive to rebalance.
And it's expensive.
Emerging markets.
That is their trade-off.
Right. That's been considered. Finally, an ultimate page.
2 times, right? You have 40 cents for emerging versus 20 for developed.
Correct. We computed tracking errors when you're at your maximum tolerance for each asset class. And these are tracking errors to the total fund relative to the policy target. And then if you rebalance halfway back to the target when you do rebalance, basically cut them in half. Interesting to me that being at your min or max in the Core Plus 5, the U.S. fixed has the highest level of tracking error, and that is because the expected return of Core Plus 5 is way off of the total fund expected return. So with small deviations from the target are creating larger tracking errors. But in general, these tolerances give you about 20 basis points of tracking error on average per asset class.
So what do we do? Do we go halfway or do we go all the way, guys? And then rebalance.
I think it depends. I don't think we have a rule. It really depends what we're trying to achieve.
The recommendation is halfway, and I've seen clear response.
That's what I would say, not a majority, but the plurality of historical studies have suggested. Going halfway back
Because you just
to the
incur
target.
transaction costs and you don't get the risk benefit. So there's sort of risk is transaction costs are linear, but risk is non-linear. So you don't get the benefit, and you simply incur the transaction costs if you go all the way back to target. Did I say that right? I think I heard that right.
That's correct. And then we just recap the ranges, the suggested ranges. And in discussions, we are not looking for an approval today. This is the SIS methodology that we would be recommending, but it makes sense to think about this in context of what BAM is doing for the other funds as well, and to try and move towards similar policies across the funds. But this is our best stab at it.
Now, one of the things you have here on page 17 is footnote 3 for parking places.
Yes.
Which reads, We don't have any police REIT managers.
We don't, but I think we have, through the toolbox, an indexing capability.
Do you have an index for REIT?
We just did a REIT RFP for the systems that have rates that would be teachers and fire, and one of the options is a passive alternative. Both U.S. and global.
So we have to set that up for police.
But didn't, through the toolbox, when we hired the index manager, doesn't that allow us to do a REIT index at State Street or BlackRock?
I don't recall from your REIT manager. I could be wrong.
But we have a
But we
passive REIT.
do have
REIT
a
RFP.
U.S. and a global alternative from the REIT RFP.
Right, so we'll have one in the toolbox now.
Great.
But again, that tool isn't in the police toolbox, so I'm not quite sure what we have to do to put it in the police toolbox.
I'm not either.
Who's the rule expert?
To your left.
I know. That's why I'm looking left. Guys, left.
Sorry, I would, if that's what direction we want to go, I'd bring it to the board and let them know.
Just to add it to the toolbox?
Does that make sense to you guys?
Okay.
So what I'll do is I'll check our notes to make sure when we did the toolbox that we didn't have it as in the original list of tools in the box. I don't recall that we did.
Yeah, just double check on that, and then get back to everybody with, I guess, if it was, with a copy of the minutes that.
If it wasn't, makes it easy.
I think it was.
If it wasn't, then we'll have to address it at the next meeting. Right?
We'll come back to you with a proposal for the next meeting. 'Cause if we have
If it was, then just copy the minutes and send them out to everybody.
Yeah, I tend to think it wasn't.
It seemed what it was. We just went through with the other guys, so we'll circle back to you and tell you where the other guys are at. If you want to pick up the same one, we'll just stick it in the toolbox and be done with it.
Although it seems quite logical as a parking place, I'm just wondering what the reporting will look like in the future when you show an asset class that's only there for parking purpose but wasn't good enough to invest in the first place. Just seems a little odd.
Well, what compounds that too, Bob, is what I'd like us to think about is if we make commitments. So, for example, in opportunistic fixed income, Larry said we have 2.5% that we've already settled with managers, and it's finished the documents, and then it'll take them some time to draw it down. Putting that into high yield, even 20% at this time, may mean that if you have a 08 type scenario, we haven't set aside enough cash, and we're going back into the rest of the portfolio to get some cash. So part of the question about parking places that I have is if you have commitments that have already been made or that are just being sequenced even as we sit here, do you leave the next 12 months worth of commitments in cash? And this only applies to, so BAM has to actually give the board some clear projections of when we expect to get invested. And we have to Bob's point, separate out from the policy portfolio, the parking place portfolio, which is shown by, here's how much we think we'll get invested in the next 12 months, and then we're just parking and investing what we think will take longer than 12 months.
So you want a parking place for the parking place?
Yeah, I was going to say, the parking place, it just sort of ends up as a pro forma range. That's all. Otherwise, you're going to make it one level too complicated to manage.
Well, think about number one. Think about the absolute return. That's actually more to my point, right? Go back to Roy's question. We're sitting here with 40+% VIX all. We know that SEMA is working as hard as she can, and in the next 6 months, we will have committed, you said 1.5% on hedge. As you've already done 1.5%.
In 3 months.
Yeah. Do you want that in cash, in equities, when you know you're going to put out that money in the next 12 months? It's a question.
I think you do. I think you want to reflect your policy, and that reflects your policy better than cash. That would be my answer.
So there's no, because I would never invest in equities if I knew I needed the cash in the next 6 months or a year, right?
You don't know that. They have typically have a 3-month draw, or 3-year drawdown period, not the hedge fund.
The private equity.
But the private equity does.
That's clear. That's
Same thing with real estate.
why I think it's linked to BAM's giving us a cycle, right? BAM's, calendar.
Okay, I see your point.
It's totally linked to BAM's calendar, and...
That calendar's going to be wrong. It's just going to be wrong. You just plan, you've made believe we can plan private equity drawdowns. Not plan it. We can give you a range, but it's going to be as big as we have to truck through that range. Because don't forget, it's offset by realization. And the other way.
Sure, it's a whole cash flow model.
It's a whole cash flow model. I've never met any of those cash flow models that are right. Of all the consultants we want, except the general consultants, of course, we only have one. But when you look at the other one, it's impossible to model because you have to make too many assumptions, which is why you get to something simple like a parking place.
I mean, for hedge funds, though,
Hedge funds go in.
Yeah.
That's easy. That was an easier one.
those go in, you're right, those are monthly subscriptions. So whenever we're ready, board approves, we go to the fund, and hopefully we're in, Jan 1, Feb 1, March 1, whatever the next month subscription is. So, and there's only a handful of funds out there that we're considering that have this kind of drawdown type structure. But almost all of them have this monthly subscription. So I think if we are considering, if we're planning right now to invest over $1 billion plus in the next 3, 4, 5 months, then I would want to have it in equities. We'd want to have it in cash because...
So that's just today, though.
Yeah.
That's more for today. In normal times, forget today for a second, because today's a little abnormal. I would think once you have these parking places set up, you then sort of pro forma, if you will, your rebalancing ranges, and then BAM funds it. This is how we fund our current drawdowns. We get private equity drawdown. We look where we are within our rebalancing ranges. And if we're at the peak of one, we'll take it out of that. It's a perpetual rebalancing, stay in the ranges, realizing how these drawdowns kind of, on average, will sort of look. But it's really, once you set the parking places up, we end up with a pro forma rebalancing range, and then we set about it. You check this math kind of once a year to see, if we finished our private equity, if you will, parking places. We're unparked. We don't need a parking place anymore. Once you get your allocation, you can just do away with it and pro forma it out. But you sort of do it once, and then you let us manage, if you will, the liquidity of the fund within the ranges. Because it's so dynamic. That's why you have to buy into these parking places. Which is why if a parking place is REITs, we should have a REIT manager put it in there. The real estate one, for instance, this is trying to get you what you think your risk return is of this asset category, volatility and all that. And since we're half of our allocation, we're not near it. It's not really an issue yet. And then the funding is the only issue, as opposed to trying to set the model portfolio up for the right risk return. I think they're all built.
So Barry, we are at 6.5.
Hold on. We have unlimited wants but limited paper.
Go ahead. So I really like this presentation, I guess. I find the intuition, I don't have an intuition for how to think about risk versus transaction cost versus the hurdle rate of return. So all of the stuff that went on behind the scenes, I think, is very helpful for us to think about this. Larry, we are rewriting the IPS as a part of this, right?
Yes.
And
yes.
so some of these things, like rebalancing halfway back, are things that I hope we will enshrine as a policy matter, including the parking places. I guess the one open issue for me is, I believe around the table, some differences of opinion about cash. You have not modeled cash. So the question for you, Barry, is what would you advise the board as a policy matter? Is cash an asset class? Is it a implementation tool because of the conversation we just had about how to think about parking places?
We don't view cash as a strategic asset, and that's why it's not included. This is policy. And for us, in order to be eligible to be a strategic asset, the asset has to have two characteristics: the potential for capital appreciation and the potential to produce income. Cash lacks the former of those two, so it's disqualified as a strategic asset. It is then a tactical asset. So, to the degree the board allows a tactical asset depends on the amount and the faith and the ability of the initiators, whether it's a manager or, in this case, BAM. So I think those are discussions that you have to get comfortable with, and you have to set parameters and procedures, probably based on some valuation metrics that should be enshrined in your policy.
It's in process. We'll continue the cash conversation. As you know, we don't have any, but we'll continue the cash conversation. What to do and what that idea should say about it. Any more discussion on this rebalance, or anything? We don't have to make a decision today, right?
I would like to ask a question, Harry, just understand how this works. Where you mentioned the parking place for opportunistic, I'm sorry, I got the wrong one, say core real estate, half REITs and half TIPS. Now, the TIPS range is only 3 to 5% with a median of 4%, the middle of 4%. Now, if we're still a long way from filling up real estate, that would park another 2+% into TIPS, which puts it outside the range.
No, that would be considered real estate. The parking place would be considered a real estate allocation, not a TIPS allocation.
Okay, well, this gets back to my original question. How do you report it? Because it'll be in some manager that's reporting themselves as a TIP. Do you have a separate identifiable parking place? Or if you don't, do you just adjust the ranges to account for the fact that you do have these parking places being used?
The latter.
What we've done in the past is the latter.
And I think that's fine, but I think that is something that just should be explicit in the discussion of the ranges.
Very good.
Thank you.
You're welcome.
So Larry, I guess the only other open item is still how to think about alternatives. And when you put all fixed income as a category, my preference is to pull opportunistic fixed income out of that because, again, I don't see us rebalancing that. So just food for thought for continued
It's totally rebalanceable.
Yeah, I included it.
opportunistic fixed income.
TIPS were
The
not.
way we have them set up, the way we have most of them set up, not all of them. But some you're in a fund, so it's like private equity, it's not. Some is cancelable on our notice.
But I
Where they're
thought,
liquid.
the answer for opportunistic was you'd be zero.
Could be
because-
zero.
But that's not contemplated here. So just think about it.
You want to raise it. You want to
It is a range now.
Our target is a range, so our target to opportunistic fixed income is 0 to 5%. So doesn't that imply that we can either have no opportunistic fixed income or go up to a maximum of 5%?
But not 10.
Right, but not 10. Because if we wanted to have opportunistic up to 0 to 10, that's what our strategy would be.
Just square that with how we structured it. It's not a
Don't forget, it also moves around with the portfolio. Right, so you've got to have some denominator effect.
But that's why the target, but not the, you're not going to add to 10%, right? You're not going to, and that's true with private equity, and it's true with, some of the other consultants take a different point because of this issue. So it's an investment and a pacing issue, but not a rebalancing. Once we reconcile all of that. I'm sure we can, it's just about how we word it.
You going By the way, it's not 0 to 10%, it's 1 to 10%.
Right, in this case.
Don't go to 0.
Okay, any more questions on rebalancing? Covered it? That ends the controller's agenda for the public session. Take that back, it doesn't. You can follow it in the left.
I'd like to get an update from the War Department.
Sorry.
I'd like to get an update from the War Department. Last month, we inquired as to the status of the issuance of the security litigation RFP.
It's my understanding this would be something we would discuss when we completed public
And
agenda.
last month, we did it in public session, so I said that we're happy to do it anyway on. Last month, we did discuss it in public session, so that's why I was...
Right, I can say in public session that we are working on it. We have not released the RFP yet. It's not at that stage, but I can provide you with more detail outside the public session as to exactly where it is in the process right now.
Thank you. Appreciate it.
Set? You set?
So we're done with our business.
So I'll make a motion that we leave a public session and go into executive session.
Second?
Second.